Hello, and welcome back to the weekly Ship Recycling Market podcast. I'm Ingrid.
And I'm Henning.
And just like that, January is officially behind us. But unfortunately, the mood across the ship recycling markets doesn't magically reset with the calendar. If anything, February's lining up to inherit a fair bit of the same uncertainty.
Yeah, there's definitely a Debbie Downer tone creeping in. A lot happened this week. Indices moved, currencies swung, oil jumped. But for recyclers, those moves didn't exactly translate into comfort.
Let's start with the bigger picture. The Baltic Dry Index surged over 7% this week, driven mainly by Capesizes jumping roughly 12%. Panamaxes actually slipped about 1.5%, while Supramaxes edged up just 0.5%.
And oil joined the party as well. Brent pushed past $65 a barrel, closing around $65.10, almost a 1% rise in a single week. Not huge on its own, but enough to ripple through costs pretty quickly.
Then there's the US dollar, which frankly stole the show. Volatility spiked again on the back of renewed tariff threats, and recycling currencies across the board felt it.
Especially Pakistan this time. The dollar's strength hit hard, and you could feel buyers recalculating in real time. Still, despite all that, something interesting happened this week. Tonnage actually moved.
That's right. India, Bangladesh, Pakistan, and even Turkey all picked up vessels. It's been a while since we could say that in the same sentence.
And not just any vessels either. India managed to secure an LNG for recycling strictly under HKC standards, which says a lot about where compliance is starting to matter.
But while activity picked up, the supply outlook still feels shaky. Stronger freight markets and the approach of Chinese New Year usually mean fewer demolition candidates. And that expectation hasn't gone away.
Exactly. Add in upcoming geopolitical events and currency pressure, and Q1 is shaping up to be a delicate balancing act.
Turning to Bangladesh, after missing out on several ships in recent weeks, buyers finally got back in the game.
They did, and in a big way. The only reported Cape-size bulker sale of the week went to Bangladesh, reportedly at fairly firm levels, which surprised a few people given how full the yards looked just last week.
Port activity also picked up quickly. Chattogram went from flirting with an empty position to welcoming several tankers, with at least one delivered almost immediately.
But pricing underneath tells a more cautious story. Smaller tankers have reportedly been resold locally at around $330 per light ton, pretty soft, which makes that firmer Cape-size number stand out even more.
Steel plate prices aren't offering much help either. They've been flat at roughly $487 per ton for over 2 weeks now.
And the Taka slipped another 1%, closing near 123 to the dollar. When you mix flat steel in a weakening currency, buyers tend to pause. And that's exactly what it feels like heading into early February.
Still, there's a longer-term positive. Bangladesh now has 22 HKC-approved yards, and competition for compliant tonnage, especially LNGs, is clearly heating up.
Tick-tock, as they say. When green tonnage really starts flowing, preparedness is going to matter.
India's story this week was dominated by one word: currency.
The rupee took another hit, dropping about 25 basis points. It briefly touched above 92 against the dollar and closed the week around 91.80, and even weaker for non-regulated purchases.
Steel prices added to the nerves. Plates fell close to $398 per ton before recovering slightly to around $401, still lower than last week.
That combination has kept Indian pricing at the bottom of the subcontinent board. Demand sentiment is clearly dampened.
And yet, physically, Alang was the busiest recycling anchorage by far.
Nearly 47,000 light tons across 6 vessels this week, including another large tanker. So while pricing competitiveness is weak, activity on the ground tells a different story.
It raises an interesting question: whether competing markets will now pull back after having stronger runs in recent weeks.
Especially with more HKC momentum building elsewhere. The subcontinent is starting to look less like a straight line and more like a triangle again.
Speaking of momentum, Pakistan had a significant development as we discussed last week.
A second yard at Gadani secured HKC certification, becoming Class NK approved. That's a major milestone and a confidence boost for the market.
Steel plate prices stayed flat but strong, holding around $587 per ton, still the highest in the region.
The downside was the currency. The Pakistani rupee weakened about 1.4%, closing near 282 to the dollar.
Even so, buyers were active.
Several Handymax and Panamax bulkers reportedly changed hands locally, and there was competitive bidding on a Capesize as well. Gadani feels like it's quietly positioning itself for when supply really opens up,
Turkey was comparatively calm this week.
but not inactive. Demand picked up after a batch of RoRos entered Aliaga, and appetite is clearly improving.
The Lira, however, slipped another 26 basis points, closing around 43.5, edging closer to 44.
Beyond that, steel imports fluctuated mildly, and it was mostly a steady wait-and-see kind of week.
So stepping back, what does all this tell us?
It feels like a market in transition. Prices are under pressure, currencies are unstable, and supply may slow further, but activity hasn't disappeared.
HKC approvals are increasing, buyers are still engaging, and infrastructure is slowly catching up with future demand.
Which makes the first quarter critical. Timing, compliance, and currency management are going to separate the winners from the rest.
That's all for this week's Market Snapshot. Thanks for listening.
And we'll be back next week as the story continues.